I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is September 14th.
And today we're going to be going over some inflation data. We had some CPI numbers come out, and what did that do to our interest rates for mortgages?
Remember, this is for informational purposes only. This is not financial advice. And if you like what Tom and I are doing here, be sure to subscribe, comment, and like. We're local mortgage brokers right here in Phoenix, Arizona. We're only licensed in the state of Arizona, but we can help anyone look at refinancing a house or purchasing a home. We'd be happy to help. Okay, where are our rates today? The 30-year fix is at 7.22%. The 15-year fix is at 6.58%.
The FHA and VA are almost always identical. So 6.72 for FHA, 6.71 for VA.
This is from the Mortgage News Daily, which does the national survey of mortgage lenders, and they're kind of basically what is being quoted.
Yeah, so that's not the Mortgage Brothers rate, because again, we will shop wholesale lenders to get you the best pricing, but this is a good baseline rate for you, so you can compare, week by week.
And yesterday was a very important day for in the financial markets. The September 13th, the inflation number came out. 5:30 Arizona time. There's really the two inflation numbers we want to look at are the core inflation, that is with the core inflation is without food and gas. That came in at 4.3, slightly below what they were estimating. They were estimating 4.4. So without food and gas came in at 4.3. Now, inflation with everything in came in at 3.7, and they were estimating 3.5, so a little bit higher.
Yeah, and I'll tell you, we are still hyper-focused on inflation, but it's interesting. Today, when you and I saw the numbers, we didn't get them for a few hours. Usually we're on it, we're waiting for them, and I'm thinking, why are we waiting a couple of hours for it? It's because it's a lot of the same over the past few months, where inflation is coming down, it's getting under control, it's not moving as fast as people want it to, but it is still kind of acting the way that they thought. It's coming down slowly but surely. It trickles up a little bit when you look at the non-core, but overall, it's interesting. People are getting a little bit tired, I think, of talking about inflation.
And I'm not sure, again, I'm just going to reiterate for people, 3.7%. What does that mean? That means if you went shopping and purchased $100 worth of things at a grocery store 1 year ago, $100 worth, you'd be paying $3.70 more this year. Now, I don't personally believe that is the case. Everything I have ever purchased in the last 12 months, I can't even think of one thing. Someone has something that they know that has depreciated, let me know. But everything has almost up 10%.
Yeah, what we should do is in that number, actually come up with a shopping list of these are the things that you would have to buy in order to really feel a 3.7 or 4.3, because it doesn't seem to be what we're feeling.
It's not the reality. I've never talked to anybody who said, oh yeah, gosh, celery, lettuce, plastic bags, soap, everything seems to be just 3.7% higher. Anyway,
right.
It's a mystery, but that's just kind of putting it in context.
Yep. So another little variable here, and again, we haven't shown this in a while, but again, we're going to go to this 9. So just show that 9, Ed. Now go back to this last slide we're at. Compare the 9 to 3.7.
Mm-hmm.
Compare the 9 to 4.3. It's serious.
Yeah.
That is where we have come from.
That was June of 2022.
In June, so a little over a year. So again, tremendous amount of progress has been made, even though the wallets don't feel it. Okay.
So, wanted to show you this historical chart that goes back to 1965 with inflation. What's important is I wanted to highlight right here is number one, June was the most recent high. We were talking about that. That was almost 9%. It was 8.9 something. But the highlighted yellow vertical lines, those are recessions. When inflation goes up, the economy has a hard time and usually starts breaking, and then a recession is caused. And what we see with this case here is we had inflation go up over the last 2 years, or the last year and a half, really. It went way up from about 1%, 2% to 9%. And now you don't see any recession vertical lines. We didn't have any recession technically. So the question is, will we see a recession?
Mm-hmm.
Will one be caused is inflation done? Is inflation going to go back up?
Right. So what's interesting is, remember, we had that supply chain situation because of COVID. There was like nothing available. It's supply and demand. If you have too much demand and not enough supply, it moves it up. So it'd be interesting to get a really smart person to talk about that, because I do think it has something to do with how are we coming off of this high without any type of recession.
Right. I mean, right. And again, there are experts in this. We're not economists. But then again, even the most brilliant mind economists have been predicting that we were going to be in recession. Others were predicting we weren't. They've changed the rules for what a recession is.
Yeah, some say we're actually in one.
Yeah. Oh, and this is true too, because recessions, even though we aren't technically in one, it hasn't been declared. They always declare a recession. Once they declare a recession, they will actually go back and say, okay, we have been in a recession.
Which personally, I love that. It's like, oh, hey, and by the way, the final that you were supposed to take for history, you already took it. Like, oh, thank goodness.
Yeah, you've gone through
already gone
a couple
through
months.
Yep.
So we may be in one right now. But again, it may be coming later. Who knows? But inflation projection number one.
Okay, now remember, we said we're not experts. So don't panic here.
We're going to give you three projections. And Tom and I were talking about this before when I was showing him the slides, because we were kind of debating this, is that inflation projection number one could go up. But the question is, how high? Will it go above the June 2022 highs and then come back crashing down? That's a possibility. Or it could come up, maybe it goes up to 7% and then retraces back down.
Mm-hmm. Yep. And my thought is that it will go up a little smidgen amount before it comes back down.
Okay.
So again, I'm not that smart. But
projection number two, inflation may go up and be kind of plateau, basically stay high for a long time. This is actually worst case. This is when you have high inflation and it would be stagflation. You have a recession with inflation, and it just kind of sticks around for a long time.
Mm-hmm.
So that would be horrible. But that's what inflation would look like. It'd just be hanging out up there.
And the next one, projection 3, is the one that we do hope.
Yeah,
we do actually have a much better feel for this one than we do 1 and 2 personally.
Yeah. So projection 3 is that we have come up a little bit. Inflation's come up a little bit these last couple of months.
And if you look, it shows
tiny little bit.
Tiny,
tiny little movement up. But if we start seeing that the Fed's rate hikes have been really moving the economy, kind of breaking it, breaking it to the point where they want people to stop spending, and hopefully corporate spending, government spending, all that stops. So we have this, at least it stopped the ridiculous increase in costs.
Mm-hmm.
Then maybe once the Fed realizes that it's appropriate, they will start lowering that rate, and because inflation again could continue to come down.
And remember, it won't be so straight. It will be a sawtooth.
Yeah.
So we are not saying it is going to come down from today forward. No, it will sawtooth up. It will come down. It will sawtooth up again. But again, if you look historically, it should look like that, but on the downside.
Yeah. And then one more there is a projection number 4, we haven't shown it, is that it would be like this. It just keeps on going down and actually becomes deflation, where we see loss of value, which is another problem, but that does happen at times. And anyway, that happened during the COVID. We see depreciation. Right now, we still have appreciation. It's just the rate of change has changed.
Mm-hmm.
It's slightly lower. But yeah, if inflation goes below this line, that means that prices are getting actually going down. Okay.
Right. Yep. So we don't want to see them hit that line actually.
So the Fed rate is a very important, mover. It's like the cause of a lot of our mortgage interest rate changes. I mean, if people are asking what our mortgage rate's going to be in a couple of months, we usually are thinking, okay, what's the economic status or the economic indicators like inflation? But we're wondering, when the inflation comes out and job reports come out, how will the Fed react?
Right.
And this is from the CME Group, the Chicago Mercantile Exchange, and these are the futures traders betting. And they're betting whether or not, or where the Fed's going to be at, what the Fed rate's going to be at. Currently, the Fed rate is at 5.5%. So right now we're in this vertical tier. The next meeting is September 20th, and
So 97% of these future traders are saying we are going to have a no change. Yep. Only 3%, 3 out of 100, think we might go up, which basically means we're not going to go up.
So, and then it's pretty stacked that we're definitely, no one believes in the next several meetings up until really between now and January. There's no indication of anything lower, like a Fed lowering. But definitely the Fed rate, they do think maybe the Fed can increase. And what we see is that in May of 2024, that's really the last time that I guess that's the last meeting that the Fed or that the futures traders are believing the Fed will kind of hold still.
Right.
They believe that pivot's going to start in June.
So a couple of thoughts here. Count up how many of those meetings in which the rate is going to stay. 6. That tells you one of two things. One is they don't have much of an imagination, and they're like, well, we don't know what else to say except say it's that we say it's going to stay, okay? Which I think makes a lot of sense. People really don't know. They're like, please tell me what to think, and people just don't know. The other thought is this, that we've talked about that hold period. And they talked about the hold period not just being a month or two. So this could also play into the fact that the Feds have it where they want it, and they really do know. I mean, to this degree, a high degree, that this is their hold period, and it's not going to be until almost a year from now that they're going to start to pivot.
Yeah. In fact, this holding period, now I'm really thinking about it, I think that it makes sense. This is the period right here where they're just waiting they're listening for cracks, they're listening for problems, they want to see movement and spending and costs going down.
Yeah, and if they move it too quick, they talk about inflation having that like bounce back, that resilient factor, and they definitely don't want it to come back. I don't understand that. I wish I did know more about that, but if they do move too quick, it could come back.
Yeah. Okay, so June 2024 is where we kind of see that curve coming down. They are betting that rates coming down, and then again, so throughout the rest of 2024, rates coming down.
And I'll throw this out again. This is not the mortgage rate. This is the Fed funds rate, which pushes the 10-year, which pushes mortgage rates. The sooner we get to the end of it, mortgage rates will start to see it coming. So it's not like they're going to sit there and be stagnant all the way until a year from now. Yeah. No, they will anticipate that move.
So you mentioned the 10-year. This is the 10-year yield where this is the mover, the big mover, like for interest rates. 30-year fixed moves according to the 10-year. So the 10-year is trading every second of every trading hour. And the 30-year, we get interest rate changes about 2 to 3 times a day, from an average bank. So 30-year fixed rates do not change every second, but the 10-year does, the 10-year bond. So we're always looking at 10-year bond. What is the 10-year bond doing right now? And this is a look back 30 years. We see that we're at this level right now, which is about 4.25, which is where that 10-year was in about 2002 to 2007. All right. Now I'm going to do a zoom up here. I want to show you the October 21st, 2022. That was the high right here, the high that was made. Again, October 21st, 2022. That's coming up. We're about, that's almost a year old.
What did you say about May?
Oh, sorry. Oh,
maybe you didn't say May.
October 21st, 2022. That is almost a year away.
Oh,
yeah.
Okay.
So, and that was a high. Then we had interest rates. The 10-year came down. We had some relief in interest rates. Came back up in March, down and into April and May, and then interest rates started going back up. Okay, because the mortgage rates are following this right here.
And if you look at this with the microscope, you'd be thinking like, boy, are we talking about 5-6% interest rate swings? No, we're actually talking about a whole percent.
Yeah.
So, and I'm being facetious. That's just 1%. So we're looking at this through a microscope.
So we have right now. It was late August. We tested the highs that were rejected. Okay, and that was rejected. So and this is in August, late August. The high line right here, which was set in October 21st, 2022, we've bounced down from that high, which means if this resistance line can hold, then there's in trading that's a resistance line. If it can hold, we may see the interest rates just continue to come down. And that's what we're hoping for. And that's what we have for you now. If you like what we're doing, if you want to just continue to get these updates, if you have any questions for us, be sure to subscribe, comment, and like, send us an email or phone call.
Yeah, we love phone calls. All right. Thank you, folks.
Take care, everybody.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.